Welcome back to Patrick Boyle on Finance. So today we're going to talk about Tesla, who just announced their earnings last night after the market close. This was Tesla's fourth consecutive quarterly net profit, a milestone for the company whose market value now far exceeds that of any other car maker. The achievement of four consecutive quarters of profitability means that Tesla can now be considered for inclusion in the S&P 500 index. If included, big index funds would likely race to include the shares in their holdings. So let's talk about what that means. Okay, so only 2 weeks or so ago, Elon Musk summed up his reaction to the latest rally in his electric car company's stock price with one word: wow. At the company's peak in valuation a few weeks ago, it had more than quadrupled since the low point it touched during the March sell-off. With its current market capitalization of around $300 billion, according to FactSet, Tesla is now worth more than many of its rivals combined. Companies like Fiat Chrysler are worth around $20 billion, Ford is worth $24 billion, Ferrari $32 billion, General Motors $36 billion, BMW $41 billion, Honda $46 billion, Volkswagen $74 billion, and so on. Tesla announced a net profit of $104 million in the quarter to June, compared to a loss of $408 million last year. Investors had expected a slight loss, and so upon this announcement, the share price rose more than 4% in after-hours trading. As of right now, when I'm filming this, the stock price is down around 4.5%. In one indication of how the sharp rally has caught the attention of retail investors, the number of Robinhood accounts that hold Tesla stock has doubled since the start of June to around 500,000 different accounts that all have positions. Apparently, it is the 8th most popular stock at the moment in the Robinhood trading app. The Tesla share price rise has touched off a war of words between Tesla supporters who are searching for new ways to explain the price and other people who think that there's a clear sign of a bubble. Elon Musk himself hasn't even tried to justify the stock price. At the start of May, with the stock at around $780, he sparked a 12% sell-off by tweeting, "Tesla stock price is too high, IMO." So how did Tesla make money in such a difficult environment for auto companies? A big boost actually came from the $428 million in revenue it recorded in the sale of regulatory credits, in which Tesla sells its zero-emission credits to other automakers who need them in order to avoid penalties. This emissions credit revenue stream allows them to add more cash to their business at a scale unlike that of any other car maker. Total revenue, though, was $6.04 billion, around $1 billion higher than forecasts, and just 5% less than it was a year ago when there was no sign of the current pandemic and lockdown. These revenues are remarkable given that coronavirus forced Tesla's factories to temporarily shut down for part of the quarter. Elon Musk at the time referred to the shutdown order as fascist, and he eventually sued Alameda County and resumed production before attaining approval to reopen. Now, as I mentioned earlier, and the main point of this video is that the fourth straight quarterly profit means that Tesla can now be considered for inclusion in the S&P 500 index, which is the main US equity market benchmark. That possibility has been touted as one reason for the latest run-up in the stock price. It's more than tripled since the start of the year, because inclusion would mean that index funds will have to buy the stock. Now, one of the most popular criticisms of indexes that are structured like the S&P 500 is that companies only get added to the index after they've gone up quite a lot. And that means that index funds are basically set up to buy into companies after their price has gone up and to sell after the price has fallen, because that's what would cause a stock to be excluded from the index. So if a company's stock price actually is a bubble, the index funds will end up buying near or at the top of the bubble. If the bubble then bursts, the company will be excluded from the index and the index funds might end up selling at the bottom. Under normal circumstances, if this happens, it would be less of a deal because the company would often be added to the index on its way up when it's much smaller than Tesla is right now. And it'll start out being one of the smallest companies in the index. And so index funds won't necessarily put that much money into it to start with. Tesla is unusual in that it grew this big in terms of market cap while being ineligible for the S&P 500 due to the lack of 4 consecutive quarters of profits. So that means that it will join the S&P 500 if it's added as the largest newcomer ever. Now, Facebook was the last huge company added to the index back in 2013. But at the time, its market cap was around $120 billion, which is significantly smaller than Tesla is right now. So with a market cap of $304 billion, Tesla is actually the 12th largest US company. It's bigger than well-known companies like JP Morgan and Home Depot. Now, it's quite possible that the S&P might not add Tesla this year, but now that it's eligible, you can imagine that they're probably going to see some pressure to add it just given the company's size. Matt Levine at Bloomberg has done a calculation showing that if added to the index funds and other closet indexers might have to buy $50 billion worth of Tesla stock on the day that it's added. Even if critics are right and the main buyers of Tesla stock have been Robinhood investors or sort of small retail investors, these small accounts, he calculates, can only have bought around $5 billion worth of the stock. An index add would require a buy of 10 times that dollar value as of today's stock price. So let me know in the comments section below what you think of all of this, and don't forget to hit the like button and subscribe. Bye.